Welcome to TradeTheNBA.com. This is John. This reports for the 17th, and I'm just bypassing all the daily and everything because it's the same old story revisited. But just look at this from this buy signal, and yeah, I think that pretty much tells the tale of what we've been experiencing. And you know, some people are talking about it being a big part of that liquidity pump that the Fed did. You know, part of the repo action and that, which is true. But you know, you can complain about all these things that the Fed has done, even from when the Fed intervened, and it is what it is, because here's the market, and you're either going to complain about it because you chose to stay out, or you know, your fear kept you from doing anything. But this is what makes markets work, and this is what will ultimately lead to them cheering when it pulls back. But we already know what that's going to be. We get the little positive extreme going right here. And we're going to mark that. It would be 33.09 range. And then at the beginning of this run, from a deeper dip, we're going to be at the 32.95. So there's not a whole lot of, you know, hand wringing or anything. It is what it is, and we're fine with it because we've been capturing the right side of it the whole way through. Even the daily opus, if we look at that from the daily standpoint, captured that from the Iron Hawk at the highs, you know, and everyone was like buying the highs, you know, on a dip, and it's like, well, yeah, but it's successful. It happens to work out, you know, 60+% of the time, and it's hard to pass up that kind of win ratio when you can take advantage of it. So here, you know, this, I guess I just want to be, you know, cautious to those that, because I get a lot of emails that people are like, doesn't this market have to come back, blah, blah, blah. Well, of course. But if you go back to the charts of the mid-90s, as I've been referencing, you will find there were months and months where there was literally just the tiniest of pullbacks in any given day on a daily chart. And that's what I said to expect those few years back when this all began, because now we're recognizing that it's behaving in a similar pattern. And if they're able to sustain it, you know, barring some unforeseen event or some political calamity that could throw a monkey wrench in it all, the environment is poised for business to prosper, and that is not a bad thing. It's just going to fuel greater activity. The real question mark will become this automation and how rapid that becomes, and if it really displaces workers, blah, blah, but we'll deal with that bridge when it comes. Of course, this is going to impact gold. Gold is going to continue to stand a reasonable elevation, I think, here, simply because this is extended period of strength now, and we're starting to see some constriction that you might actually begin to see some inflation. It really is going to depend on, of course, our oil. And oil, while we've retraced this slightly, is still relatively higher than the previous lows, but not at a point that's causing any pressure. You see, and that's the critical thing. You have to have a catalyst. There needs to be a trigger point for negative reaction to things, and we're just not experiencing it at this particular time. So, but we'll see it change fast when it does on the 5K. It will be quick. It could be like 1 second, everything's good, and then all of a sudden, a little signal cell starts, and then it just keeps going, and you know, that will progress when it does, and we'll be able to see it because the daily will start to reflect it. We'll end up with much lower shakeout, dipping, and then it'll spread through the 50K, and then of course affect the daily charts as well. So we'll just keep an eye on it. But as always, though, trade well, and if there's anything new on the charts, I will put them up. There wasn't anything new the other day.